So the statement made here in this book, this statement is not correct. Right? This statement is not correct. That charts are mostly, he's talking about the momentum approach, that most technical approaches are momentum based. The statement is not correct, and we explain why. All right. So this we don't need here. Somewhere else. Okay. So let's go to this. Yeah. All right. So page 19. Let's look at page 19. Now this is done. He's talking about. Yeah, so this is actually so Dow theory. Dow theory is a technical theory. I've given you the references for technical analysis. When you read those books, it's better to read instead of reading this guy's impressions of Dow theory. It's better to read the books I gave you by Jack Schwager and by Perry Kaufman on Dow theory, because that will be a much more respectful and meaningful and more knowledgeable treatment also, because this guy doesn't even understand. Graham doesn't even understand technicals properly to be aware that all technicals does not represent, all TA does not represent a momentum approach. So we should not be relying on Graham's take on Dow theory for to learn Dow theory. Okay, so this is we're just going to continue here. You see what remarks I've made. So value investing is a mean reversion strategy that I already explained. Okay, I hope everybody's clear about this. So this is one thing to understand, that value investing is one type of mean reversion strategy. There could be other types, as I showed you the other day with technical oscillators like RSI, momentum. I mean, there's also an oscillator called momentum. Okay, so if you go, so don't get confused between the momentum approach. So if you go here, okay, I found a very good website. Okay, where is so I've given it to you here, I think, in your notes, in your project, a very good charting web application. Under tech, added this part, okay? Good charting application. So I added it for you. Yeah, charting applet. So I took Google as an example. So let's take that. It's a very good charting applet. You can experiment with this, and you can just create a free login. You'll get some other facilities as well. And so this is a very good charting applet. You get lots of nice long-term charts. So 1 minute. So this is the Alphabet. This is the holding company. Okay, so you don't have to try Premiere for free. You can get pretty good chart. But this one actually, unfortunately, to get a good picture of the chart, you have to really, yeah. So if you take Google, for instance, here's a classic example. Nobody has Google as such, but if you look at Google, now Graham has made a very, disparaging, taken a very disparaging view of first of all, look at Google long term, see how good it is, okay, how good it looks. And so there you go. This is how you have, unfortunately, you have to really zoom it down 50%. And what I'm going to do in the studies is I want to get rid of the volume. All right. So here you can do lots of studies, and you can look at the various types of studies. Now, unfortunately, I cannot read much, but you will see that there is a study called momentum. Okay. It's a momentum. It's a very simple indicator. This is an oscillator. All right. So there are some other momentum oscillators, but there's a simple momentum oscillator. Okay, which there are two period and movement. Okay, what is the so the differences between two? So you can add it, but it's basically, I'm not going to add it now. So when you see this momentum oscillator, there is no study here right now. Okay, so don't get confused between the momentum oscillator and the momentum approach. So what I've taught, these are two different things. So you have to be aware of that. Okay, so when we are talking about momentum versus mean reversion, which is your topic here. Okay, this momentum here is different. This is momentum investing. Okay, so maybe I should clarify this in a little bracket here so that you don't get confused. Okay, so momentum in this discussion let's put it this way. Discussion refers to momentum investing, sort of. Okay, momentum as an investing philosophy, or momentum. Okay, it's not to be confused with the momentum oscillator. Okay, with momentum in PA. Okay, with the momentum indicator. Okay, let's call it an indicator. In PA, which is an oscillator. Okay, so this is just for your guidance. So because I use the word momentum and I showed you another momentum also, you may get confused. So this momentum, when we are talking about this momentum versus mean reversion, these are two different philosophies. Okay, investing philosophies. These are approaches to investing. Okay, we saw the other day that Aditya had a leaning towards a momentum approach, and Ankit Arora seemed to have a leaning a bit more towards a mean reversion approach, just based on the initial responses. So those are basic approaches, and the idea is that they will have the same kind of approach no matter what chart you show them. Now that is different from momentum, what I showed you here. This momentum, okay, which is nothing but a study. Okay, if you just do this, here momentum, and it will come out as an oscillator. Let me just show you once. Okay, so it's basically a difference oscillator. Okay, see, this is what it looks like. Okay, this is how it gets plotted. Okay, momentum. Mainly it is this which I'm interested in, this line. Okay, so this is an oscillator because it is typically it will typically oscillate between two values. Okay, here's the top range and the lower range, and so here you would so it's very much like RSI. It's used as the same as an RSI. That's why we say it's an oscillator. So don't confuse the two momentums. And here once again you can see straight away why this the disparaging. See, in this book you'll notice one thing, because it's a value investing book, and because value investing is a mean reversion philosophy, so Graham has been very disparaging towards momentum investing. Okay, he's very much very disparaging towards momentum investing. But as you can see here from this chart of Google, from Alphabet actually, you can see how dramatic it is, the rally after COVID. If you zoom in, you can make this a little bit better. Yeah, we can see a little bit more now. If we go here, as you can see here, if we can even look at 5 years, you see how dramatic the rally is. Okay, from about 1200 to almost 3000 now. What a dramatic rally this is, and this is classic. This is a classic trend for momentum investing. Of course, there's a little break of the uptrend here, but then again, it makes a new high. Okay, as soon as it goes up again here, this segment of the trend was destroyed here. You had higher highs, higher lows, and then a little bit of a break, but again, it goes up. So you can see that the momentum approach is not that stupid. Okay, it does. There are certain times when it works out quite well, and right now in tech, it's working quite well as well. So therefore, this is just a proof that, and this is a very, very major stock. Okay, one of the biggest companies in the world. So this is just a proof that this kind of a disparaging approach towards momentum investing is not correct. All right. So just to make that clear, that this momentum is not to be confused with momentum as the technical oscillator. This actually should be just make it. Okay. All right. So let's just go back here. So that's your entire discussion on the momentum investing. Just clarifying that remark in the book. Okay. Now let's continue on from here. So this is a long discussion which we had, so it should be clear. Otherwise, you can just play back the videos. So let's go to page 1819. So see what we have. This is following the market. So it's after 16. This is 17. Okay, I'll just run through. I don't have any remarks, so that means there's not much here. This is just a historical narration, like what happened here, etc. So we don't have too much to comment on here. Other than what I said about Dow Theory, don't rely on this book for Dow Theory. Use the TA textbooks that I gave you. All these you can just go through yourself. This is just history, and it doesn't hurt to know all this. Okay. All right. Here now, see what he's saying here is that the market went down in 69.70, and we'll try to see. These guys have very good data. So if we, I don't know if they have S&P. S&P, they have the spider. They don't have the index. Where's the index? Well, the spider may not have that much data. Let's look at Dow Industrials. They all got the spiders. They don't have the They don't have the. Okay, so let's try for SPY. This is the ETF which tracks the S&P 500 index. Okay, so we went for that, and I'm trying to see if we have how much data these guys have. It's actually a good charting application, and you get a lot of facilities for free, and they have a lot of data. You can just click on Max and see. How much data they have, and we can get rid of this momentum oscillator. Okay, let's look at this. Right, we are from 1994, so they don't have that much data. Okay, so it doesn't matter. It's here, and here again you can see. So when you're talking about trashing momentum investing, you can see how strong the momentum is in the stock market here. Even here is quite strong. Then you have that one COVID drop, and then again it rises. All right. So it's quite, momentum investing can be quite rewarding if you can do it right with discipline. It can be quite rewarding. Now, what is it saying here? It's there's a drop in the market between 69 and 70 in the stock market. So he's saying that this is basically dispelling the illusion that leading common stocks can be bought at any time at any price. Okay, that any loss was going to be limited. Now, you might have heard this a lot on local television as well, because a lot of the people who are invested, who are sort of involved in the stock market, like stakeholders. So you'll find that people from the stock brokerages will always be giving you a bullish view of the stock market, because you have to look at their incentives and their interests. What happens with brokers typically is when you have a crash like this, the public, the general investing public is likes to be on the long side. Okay, they don't like to go on the short side. So in a kind of a bear market like this one, okay, this is the drop from 2000, the bursting of the internet bubble, the decline from there. In these kind of situations, the investing public does not really participate much in stock markets. So the investing public likes to participate from the long side. So you have to understand the politics of this, or the incentives involved. You'll find that people from the brokerage houses are always bullish on stocks. And this is the kind of thing that they'll be telling you. They'll be telling you this kind of stuff, that, you know, if you buy blue chip stocks, you can buy at any time. You don't have to time the market. Eventually, the stock market always goes up. The kind of stuff that we already discussed earlier. I showed you the problems with that logic in the case of GE and the Nikkei, right? So the problem, you have to understand the incentives here. This is very important, because a lot of the things you hear in the industry are a lot of the opinions you hear from so-called experts. The opinions are all tainted by their incentives. Okay, so think about it. If I'm a stockbroker, okay, if I'm working for a stock brokerage house, or if I'm the CEO of a stockbroking house, what is my incentive? Obviously, I have to increase my income. And how do I make money as a stockbroker? I make money by charging you commissions, trading commissions. So I want you to trade actively, and I don't really care whether you make money or lose money, because either way I get my commission. All right. So basically, what I want is I want you to be active in the market, and so that I can earn my commissions. So, and we know for a fact that when the markets go into negative bear phases like this is the bursting of the housing bubble in 2007, and then this is the Lehman Brothers bankruptcy. So the crash, the global credit crisis. and then the central bank started, really inflating the money supply, and that led to a dramatic. According to me, this is the main reason for all these rallies, okay, in the stock market. And actually, the central banks have gone even more crazy after COVID. They have completely lost it. So that's why the stock market, according to me, is going up this much, because I don't think the economy as such is that great to justify this kind of thing. It's basically all liquidity driven. That's my assessment. No one can be sure actually, but this is my reading of the situation. So anyway, so if we know that the public does not like to participate much, so trading volume tends to go down when the market is a little bit down. That's why these brokerage houses will always tell you that they'll tell you this kind of stuff, that you should be willing to buy stocks at any time, because they want you to trade. So you have to understand the incentives. They want you to trade. When you trade, whether you make money or not, these guys make money because they charge you commissions. So you have to understand, when somebody is saying something, always learn the skill. Otherwise, you will be fooled in life. Okay, a lot of people will make a fool out of you, because there's no shortage of dishonest people in the world. Always look out for the incentives. If I'm telling you something, you should be asked on some particular topic. Okay, if I'm telling you something, well, like, let's put it this way. Let's say I'm Pfizer or I'm Moderna or one of these vaccine companies, and I'm telling you, suppose I'm somebody who's working on the board of that company, and I'm coming and telling you that yeah, you should take the booster shot. Yeah, because if you take the booster shot, then I make more money, right? My company makes more money. Now, that may or may not be, the booster shot may or may not be technically correct. I'm not commenting on that, but you can see straight away that there is a conflict of interest. Because so you should always be alert to these kinds of conflicts of interest. Like, I'm telling you to do something which will benefit my company. So how can you trust my advice? I may actually be technically correct, but you have to be aware that you should not just blindly trust people. Okay, so this is very important. Otherwise, you'll be made a fool of in life. So always remember to look out for the person's incentives. Understand the guy's incentive. Whoever's saying something, whoever's giving you advice, what are his incentives? Okay. Now, what am I saying here? Yeah. So if you look at this, so the comment I've made here is page 18 to 19. What is he saying actually? Page 18 to 19, what he's saying is that the decline in the market in 69.70, okay, is basically puncturing this kind of hypothesis that you can buy blue chip stocks at any point of time. Okay? And so then later on 18, from there he's going to 19, and that was too good to be true, and the stock market has returned to normal, etc. And both speculators and investors will be prepared for significant and protracted falls, okay, as well as rises in the value of their holdings. So the comment I made here is, if you remember that some time ago, a few pages ago, he had made a comment about dollar cost averaging, right, page 16. And he has actually given a favorable view of DCA. If you go back to page 16 and read it, his take on DCA is actually quite favorable. So in that sense, I've said that there is a little bit of, so you should watch out for these kinds of potential inconsistencies. That's why I said somewhat, maybe it's not that strong. So if he's saying, on the one hand, if he's in page 16, on page 16, he has praised dollar cost averaging. And what is dollar cost averaging? Dollar cost averaging means that you are buying stocks throughout. You're buying here, and when they're coming down, you're still buying. When you're going up, you're buying, and you're coming down, they're still buying. So that's what dollar cost averaging is. Dollar cost averaging, you don't try to predict the market, or don't try to wait for a better time. So actually, this is slightly inconsistent with what he's saying here, that you may have protracted falls, okay, in the prices, okay, and significant falls in stock prices. So if that is the case, then why should I engage in dollar cost averaging? It's kind of stupid, because it's also not consistent with the value investing philosophy. If you try to understand the value investing philosophy, the idea in value investing is to wait for declines like this. You'll get a sense of that when you read the rest of the book. That is the basic idea in value investing, that you wait for some kind of a market panic, somewhere like this or somewhere like this, and then you buy. Okay, or you wait for a COVID sell-off like this, and then you buy. Okay, so that's the idea in value investing. So there is clearly a certain sense of timing the market that is there in the idea of value investing. So it's not really consistent with the idea of dollar cost averaging. So that's what I'm trying to point out here, that it is a little bit what he's saying here is more in line with the philosophy of value investing, and his earlier endorsement of dollar cost averaging on page 16 is somewhat inconsistent with this. Okay, I hope this point is clear. So, I mean, these are just the observations I was. So this, in a way, the way I'm handling this book, I'm annotating this book. This will also teach you how to read a book. Obviously, you have to be aware of many of these things, but you can look out for inconsistencies, etc. Okay. Now, here there's an important point here. We'll talk about asset allocation later also. Yeah. So there's this asset allocation problem, which I think I'm discussing it a little bit later as well, but I think I should bring it up on page 19. I wanted to comment on. Yeah, so here we are on page 19, and let's read further. Why have I made this note on the all bond policy? Okay, that's a quote from the book, and I wanted to discuss a little bit more here because there are certain other things that you should understand here. Some important concepts. Okay. Now, what is he talking about? Okay, so first he says that stocks can come down a lot. You should be prepared for that. 1 minute. Let me just set your alarm properly. 1 second. Oh yeah, we got the alarm going, so no problem. Okay. There's a message in the chat box. Let me just read that message. Okay, that's okay. Now, Ritvik has joined late. Now, this is the problem actually. I'm not allowed to do that. So you'll have to take it up with ma'am. Okay, and what I will do is you can make a note of the day, and then since I'll be sharing this the attendance log files for every day, I'll be sharing it with ma'am. So then you can take it up with ma'am separately, and then let her decide what she wants to do. Okay. So I should not be deciding that. I'm just blindly applying the attendance test, and then if you fail it, then you go for the higher up approach. Okay, go for the PGDM chair approach. All right. So because I've already submitted the attendance now in the area of yeah, what were they talking about? Okay, so he's talking about various problems in the case of you know, lower quality stocks, etc. And he's talking about yeah. So the major question there, there's high rise in the interest rate on high grade bonds, and then here he's talking about yeah. So if you see here, he's basically looking at what is available, what rate of return is available on bonds and stocks. Okay, and then he's talking about this. He makes the statement about in previous editions we have whatever the split between bonds and stocks. Okay, would it justify an all bond policy? This is the part that I have extracted. Okay, so these kinds of statements actually, ideally, according to me as a teacher, when we are teaching students who are all new to investing, okay, and they don't have a structured view of the you know, all the concepts that are important in the domain. According to me, before introducing these kinds of statements, actually we should actually teach the students about what is the context. Okay, what is the context in which this is happening? He's obviously talking about, okay, you have a certain amount of money to invest, and he's talking about how much should be put in bonds and how much should be put in stocks. But there's actually some formal ideas that you need to be familiar with here. Okay, let me bring, I think later on when I have asset allocation, somewhere later as well, I'll discuss. Yeah, that's okay, fine. Asset allocation, there's already been discussed here. So let me just take this from here, and I'll have on page 36 also I made a comment about that. But since we are already coming to asset allocation, so we need to discuss a few things here. Okay, quite a few things, very important. Okay, so first is this term. These are terms that are used in industry and they have specific meanings. All right, so you need to be familiar with this. So this basically, you can talk about it as the asset allocation problem. Okay, you can talk about this as the asset allocation problem. Okay, what is it basically? It's about deciding how much how much of the fund of a fund to invest typically. Okay, employ as a more general term in different asset classes. All right. So if you go back to your Finviz page on futures, okay, which we have used to give you a sense of the asset classes, we come back here. We have here you can see bonds. Maybe you can't read it much because it's a blue background. So here you see bonds, 30-year bonds, 10-year notes, okay, and they haven't shown the bills here. Actually, you can also invest in treasury bills, which are less than 1 year, okay, less than equal to 1 year. Now, so these are so you can see this is 2 years, 5 years, 10 years, 30 years, different maturities for bonds. And so you have bonds here, and then you don't have stocks as such. You have stock indices. We can take these as proxies for stocks. Let's say you're a passive investor, so you'll be mainly investing in index ETFs. All right, so you have like S&P 500, Nasdaq. We can treat these as different equities. Okay, these are equity indices and like an international portfolio of equity indices. All right, so this is the kind of decision. So how much money should I put into these equity funds? How much should I put into a bond? And then in more general terms, how much should I put into commodities? Within that, how much into this, how much into softs, how much into metals, all that. All right. So in general, so the asset allocation problem, what is referred to in industry as the asset allocation problem. So this has a specific meaning. You need to be aware of it. So this is basically about deciding how much of a fund to invest in different asset classes. Okay. So actually, this terminology is not very correct because if you write, using English in a very, very strict way, but this problem exists in industry in a lot of terms that we use in industry. This kind of problem already exists. So this kind of problem exists in the industry, and so the problem is what is the problem with this asset allocation term? The problem is that when you say asset allocation, the word allocation is qualifying the word asset. So this means that ordinarily, if you ask a computer to interpret this, this would mean that based on the structure of the expression, there is the asset that is being allocated, but that's actually not correct. What this actually should be is allocation to assets, okay, or allocation to asset classes. So the correct term should be actually technically correct term, English language wise, should have been allocation to asset classes. That would have been the correct term. Okay, but don't try convincing anybody in industry. So the way you should learn it in your head is you understand when people in industry refer to the asset allocation problem, what they actually mean is allocation of a fund to different asset classes. Just write it this way. This is what is actually meant. Okay, so this is not the same as asset allocation, because asset allocation means you're allocating the assets. Okay, so understand the language problem here. But this is how people have gotten used to it. So nobody in industry is going to change because your teacher is saying that this is not the right way to say it. This is the right way to say it actually. Nobody is going to change there. So you have to understand it at two levels. You should understand what this means, but you should also understand so that you can use the language in a more precise way, like a computer. And you should understand that the correct expression should have been allocation of a fund to different asset classes, or allocation to asset classes, if you want to make it really short. All right. So this is the general problem. Okay, asset allocation problem. So this is an expression which has a particular meaning in the industry. So you should learn it. This is what we call a term of art. Okay. Now, in the context of this, you also should learn about two things. Okay. You should also learn about the difference between. Let me take this here. We are going to also learn another topic, very important to understand: traditional asset management. We are going to make it short so that it fits in one line. And we're going to say traditional versus alternative. Okay, so traditional is contrasted with alternative. So this is to be read as traditional asset management versus alternative asset management. Okay. So alternative asset management is sometimes referred to as hedge funds loosely. Not a very correct definition, but that's again another kind of industry parlance that is used. Should be aware of that. Okay, so let's understand what these two are. Okay, so the asset allocation problem also brings up a related point which you should understand: the difference between traditional versus alternative asset management. These are different approaches to asset management, and they have a kind of a legal dimension as well. Typically, in terms of the fund's mandate, what the contract with the fund between the fund manager and the investor. Okay, so we want to understand what is meant by traditional versus alternative asset management. So typically, what you are familiar with in the industry, if you see in this book, they're talking about things from a traditional asset management point of view. That's why you see his discussion is always between stocks and bonds. He makes no mention of investing in coffee or investing in soybean meal, okay, or investing in Japanese yen or in the Swiss franc. Okay, he makes no mention of these things because this value investing typically, especially in equities, and generally value investing has always been a kind of an idea that belongs to traditional asset management. That's why you see the discussion is confined to stocks and bonds. So that brings us to an understanding of what characterizes traditional asset management. So there are three things. Okay, one is equities and debt. Okay, that is what asset classes can you invest in. In traditional asset management, we are going to talk about a distinction between traditional versus alternative asset management. We are going to look at the distinction. So it's like difference between boys and girls, or difference between Indians and Japanese. Okay, how can you make distinctions? On what aspects would you make the distinctions? So this is basically it, right? So let's look at the aspects on which you have the distinction. First is in which asset classes can you invest, or investable asset classes? The first point. So in the case of traditional asset management, the investable asset classes are equities and debt. Okay? So cash, sometimes you'll hear the asset allocation discussion in traditional asset management as equities, debt, and cash. You'll see this here also. Okay, he's talking about equities, debt, and cash. So cash is understood because once you get the stock, okay, if we go back to your, we should actually open your spreadsheet here. If we go back to this thing, this is what is happening, fixed asset, current assets. Okay, so let's have the current assets initially. So you have zero fixed assets when you start your fund. Okay, so you have current assets, and the current assets is only basically just cash. You start with only cash. So there's no question, your inventories will come up, your stocks and bonds will become your inventories. Okay, so you start with cash, 750 cash. So that means your cash, let's put it this way here. If you're looking at a fund, okay, then if you have equity and then you have debt, okay. So initially you start with 750 cash, and this you make as okay. So here you have 750 current assets, cash. Because you start with cash, when your investors give you money, that's in cash. So you can either put it in treasury bills or short-term money market instruments. That's also considered cash. We call it cash and cash equivalents. So when you're looking out, look out for this. That in the you'll find this throughout this book. You'll find the discussion throughout this book. That later on also when we have a discussion about how good are stocks as a hedge against inflation. There's a discussion later on how good are stocks as a hedge against inflation. Yeah, this discussion. This is happening on page 37. You'll see again he's talking about cash, equities, cash equivalent, near cash and cash equivalents. All right. Here we're talking about this. We're talking about the asset allocation. Now we're talking about traditional. So in traditional asset management, when we talk about the asset classes, it's mainly equities and debt. What are the investable asset classes? But you see the debate happening in terms of okay here. The debate will happen in terms of equity. Sometimes you'll see these fund managers being interviewed on TV, and the anchor will be asking them how much of cash are you holding right now? Okay, so if I'm holding 100% cash, that means that I don't have a good view of either equities or debt. Okay, either equities or either debt. I'm not very confident about the bond market performance, future performance. I'm not confident about the equity index, equity market performance. So I am mostly in cash. Okay, so you will see this kind of discussion that is happening on TV as well when they interview fund managers. Oh, what is your cash allocation right now? Okay, so that's meant to indicate the level of confidence you have about the other asset classes. Just hold on a second. Right. So in general, so we don't really talk about cash, but it's there. So what happens now? Suppose you buy, say, $200 worth of stocks. So then this becomes 550, and this becomes 200. Okay. So your total asset value does not change, but we say that there is a change in the asset mix. Okay. So now you have some. This is technically equities in a fund. Equities would be considered part of your inventories. Okay, so you have bought now $200 worth of equity. So cash has gone down by 200, and now you have 200 of equity. Now if you put another 100 in debt, or if you put 150 in debt, then this goes to 150. This goes to 400. All right. So this is what you have now. You have got a change in the. We say that there is a change in the asset mix. The total assets have not changed, but the change in the asset mix used to be all cash. Now you have cash and basically inventories for this type of business, and that's equities and debt. So this is the change in the asset mix. So this is the kind of allocation that we're talking about. So in traditional asset management, on the first question of what are the investable asset classes, the answer is only generally equities and debt, but you will find the discussion happening in terms of cash also, and for this reason, that the fund manager who is very bearish is not confident about investing in any of these two, then he keeps all of his money in cash. Okay, and that's an index of how confident or scared the fund manager is about the future performance. So stocks, bonds, and cash. You'll see the discussion happens in TAM. We'll call it TAM and AM. Okay, alternative asset management AM, and this is TAM. So in TAM, the discussion happens between stocks, bonds, and cash. But the correct terminology would be equities and debt. Okay, and cash, of course, is understood. All right. So this is one. This is one aspect. So in contrast, when you have, let's draw the contrast here. Okay, this is our topic marked with a star. So we are now explaining these contexts. It's very important to understand the asset management landscape. Now, alternative asset management, what do we have? In generally, any asset class. Typically, you're free to go into any asset class. Now, you may still have, you may still decide to go for, only a few of the asset classes. But technically, in general, we consider alternative asset management funds as free to go into anything: soybeans, 5-year notes, natural gas, then maybe Australian dollars, okay, anything. All right. So in general, they have the freedom. That is the basic idea between the difference between traditional and alternative. Okay. So any asset class, that's one. On the first question of the investable asset classes, we can save some space here. All right. Now, the second question is on the question of the second distinction between the two is on the question of positions. Okay, position, you understand? Position is either long or short. Okay, so either I buy or I sell. So position, if I buy, my position becomes long. If I sell, my position becomes short. Okay, so the second distinction is on the question of position. So the rule in traditional asset management is long only. So that's why, if you remember, when we were discussing the value investing kind of discussion, the price versus fair value paradigm, and we talked about what is happening in General Electric. Okay, here you are. Okay, so if I feel that the fair value for General Electric is even lower than where we are. Maybe it's $16. So if I do this kind of value investor, and I see that the fair value is $17 or $16, okay? Then what I'm going to do, and then I look at the market price. The market price is, well, is it 104.70? Okay, 1 minute. Seems like a lot of difference. Yeah, so 104. So if I feel that, let's say here, 5 years, okay. So if I feel that it's actually lower than that, it's $16 is the fair value, the current price is 104, then technically I should sell, because the price versus fair value paradigm, here we assume that price will eventually move to the fair value estimate. So I should sell, but typically value investing is something that belongs to this sphere, traditional asset management. And here the general rule is that when it comes to the position, we don't go short, we only do long. Okay, so these are called long only funds. So therefore you will see that a value investor who looks at General Electric, and if his assessment of fair value is say $16, price is 104, he's not going to sell. What he's going to do is he's not going to buy. Okay, so the answer is don't buy. Instead of selling, the answer for him is don't buy. But if his assessment of fair value had been say 300, then he would have bought, because the price is far below this. And he sees the price eventually. So in value investing, if you remember, in any kind of mean reversion approach, our fundamental assumption is that one of the fundamental assumptions is that eventually the price is going to move towards my estimate of fair value. Okay, remember, fair value is always subjective. So therefore this is the thing. The second is on the question of position. In TAM, we have only long positions, whereas in AM, we are willing to go. These are called long. So the technical terms, please remember the technical terms. These are what we call terms of art. So when we say asset allocation in finance, it has a very specific meaning. That's why I'm spending all this time. Why am I spending so much time on page 19? Okay, so technically slowing us down on the coverage of the book, but because these are all raising questions related to, these are all basically assuming some knowledge. These points should be discussed after giving the students some background information on these kinds of concepts. And you need to understand, because these are the terms that are used in industry. So you have to understand these things before you can make sense of these kind of statements. Or you have the right context for that. Okay, so here, these are all terms of art. So the term we use is long only. Okay, so if I have a long only equity fund, then you understand what that means. Now here we say the term we use is long short. Okay. Right, so I may have, if I'm running an alternative asset management fund, okay, sometimes called only hedge, sometimes also referred to loosely as, write it here. Maybe this is not the right kind of indicator. What should we put? Because we are using it somewhere else. Bizarre indicator like this. Okay. Now, what does that mean? So alternative AM is sometimes going to be loosely referred to as hedge funds. All right. Now coming back to AM versus TAM. So these are known as, so here in AM, we say long short. So if I have a long short US equity fund, okay, I can go through this list of stocks. Okay, if I go through maps, okay, the heat map kind of a display, I can look at funds, I can decide that maybe I'll sell Apple and I'll buy Facebook. Then maybe I will buy General Electric. Then maybe I'll sell Pfizer. Okay, these kinds of decisions I can take. So this is known as a long short. So this kind of thing would be typically called a long short fund. Okay? So we say long short US equity. One example of a fund would be But there are many popular long-short US equity funds. So the very common strategy. So you focus on US equities. A long-short US equity means that I focus on US equities, not Japanese or Indian stocks, and I can go long or I can go short. Okay, that's what it means. So the name of the fund will be long short US equity fund, maybe Citadel long short US equity fund, etc. So this is basically the difference. The second difference is between these two approaches is on the question of positions allowed, the types of positions allowed. In TAM, we only allow the long positions, so it's called long only. And in AM, we allow both long and short, so it's called long short. Okay? So this is the second point. Okay, there is a third point which we should emphasize, but which will take us into the next. The third point is basically on the use of derivatives. So the simplest example of derivatives is options. So if you go to, if I look at the options display, let's say for instance, if you take any, say, if you look at Yahoo Finance as a example, okay, we look at Microsoft. Now you look at Microsoft here, you will get one option here for options. Okay. Now here I've gone for a straddle view. Straddle view means that you have calls and puts displayed like this instead of just going for calls. Okay. So this kind of so here you have options. You have various types of options. Now there are you would have done some study on options here. Let's put it this way here. Okay. Let's get a yeah. Now that's much better. We have yeah, this is much better because we have gone for this one is very, the initial display was very short term. Okay, it was August 27th, only a few days left. You go for a little bit longer term option, you get a better list of pictures. So 302 is the current price. So if you go to, you must have done some bit about options. Typically a straddle view, 302 is the price. The straddle view is like this: calls on this side, puts on this side, and there is some shading because these are all the in the money calls. So the in the money are shaded. So these are the in the money calls. You must have done all this in your first year. You did all these terms: in the money, out of the money. Yes? Anybody? Who should we ask? Naman? Did you do these terms in your FM1, FM2? Options, in the money, out of the money? No? Anybody? Yes or no? Or everybody sleeping?
Actually, we studied, but it is difficult to remember the same thing. In the money,
Okay.
at the money, on the money.
Not on
Yeah,
the money. No, not on the money, out of the money. In, out, and at.
Out of the money.
In,
Yes, sir,
at,
yes.
and okay. So 302 is the price. So there is no exact 302 strike here. Okay, just a quick refresher on options. And I ordinarily would have covered options with you on FDRM, but since I won't be teaching you FDRM, so now 302 would have been a 302 strike would have been at the money. Now these are for calls. These are in the money strikes. So the 285 call is in the money, and then the in the case of the puts, the 325 put is in the money because it's above the. So basically, the intrinsic value is positive. You have to revise all these terms later on. Okay, but the point is that options. So you have one of the options you have when you're looking at Microsoft is you can either trade in the spot market. This is a spot market price. Okay, this gets settled on T+2 basis or T+3 basis. In different countries, it's a different system, but it's usually T+2 or T+3. These are spot equities. Okay. Now, whenever you trade equities, most of the time we talk about stock markets, we talk about spot contracts. So that's T+2 or T+3. But options, as you notice, options are different. You see how many options expiries are there. You would have done expiration date in the case of options. You can see how many expiration dates are there. I think you can read it. I'll just increase the size maybe a little bit. Okay, then you can read. all the different dates. I can get option codes for all these different dates. Okay, so options are quite different, and then you have calls and puts. You have, as you can see, in the money, out of the money, much more complicated set of affairs, state of affairs. So, but these are known as derivatives. An option is known as a derivative contract. Okay, so these are all derivative products, option contracts, calls, puts, etc. These are derivative contracts. This is not a derivative product. Spot contracts are not considered derivatives. Okay, you need to know this term. Derivative contracts, spot is not considered a derivative contract. Okay, so when you're trading, say somebody is saying that your senior Vipul is trading on the NSE and he says I bought Maruti today, what he's talking about is spot contracts. Okay, but options, of course, you can trade options also in Indian equities, but those are different. Those are derivative contracts. When you're trading options, you're talking about here these options. These are derivative contracts. Okay, so futures. Okay, so if we make a note here, what are derivatives? Okay. You can say futures, forwards, swaps, options. Right. So derivative contracts are futures, forwards, swaps, and options. And so spot is not considered a derivative contract. So most of the time when you trade equities, these are spot contracts. So you have to understand the difference between these. So at least you have a basic idea of derivatives, that these are the types of derivatives. So therefore, one of the other distinctions between TAM and AM is on the question of, are we allowed to use derivatives or not? The answer in TAM is no. In AM, the answer is yes. Okay, so these are the three broad areas in which you have a distinction between TAM and AM. It's very important to understand because these are, asset management is a very big section of the or segment of the financial services industry. So you need to understand this theoretical difference. So historically, this has been the approach, TAM. Okay, in recent years, this has started to grow. Okay, and this has become, so all your private equity type of investments, these are considered to be part of or AM actually. These are considered to be part of AM because these are traditionally, it is let's put it this way, it's not really discussed. Let's call it listed equities. Okay, that's why. So when we say equities and debt, it's actually listed equities and debt. Okay. So let me use a different kind of bracketing convention. So what we want to have is this, listed equities and debt. That's why private equity is considered part of AM. Because logically you could ask all this question, the question that in private equity we are only investing in equities. Okay, like SoftBank is invested in some Snapdeal or somebody like that. Okay. Now they are also investing in the equity of Snapdeal. So then why are we calling it AM and not TAM? Because TAM is listed equities. Now, so when Snapdeal they invested, that was not a listed company. So it was a basically a unlisted company. So therefore that doesn't come into TAM. So private equity goes into alternative asset management because it's not listed equity. They don't usually invest in listed equities. So these are the differences. So derivatives, as we said here, is no, right? So this is an important distinction between TAM and AM. And so value investing is happening typically within TAM. Okay, so remember that. And so the asset allocation problem. So obviously because the range of asset classes that you can invest in is different between AM and TAM. So when you are discussing the asset allocation problem in TAM, obviously you will only be discussing in terms of equities, debt, and cash. And loosely the term that is used in the industry, nobody uses terms like this because they're not that specific. They're not that particular about how they use the language. So they will typically say stocks, bonds, and cash. Okay, but the correct term is equities, debt, and cash. Stocks and equities are okay, but even then equities is better than stocks. But Bonds is definitely not correct for debt because when you have money market instruments, those are not called bonds, but they are still called debt. So debt is the more general term, but nobody is that particular. So again, you should understand this on two levels. So people in the market will say stocks, bonds, and cash. You should understand what that means. But in your brain, you should also have one thought going out just for yourself that the correct terminology should have been equities, debt, and cash. Okay, because stock sometimes we even have a term called debenture stock. Okay, debenture stock is basically just a whole bunch of debentures together. So sometimes that expression is used. Okay, in securities law and all that. So that's why stock is better not to use stock for equities. So better to use equities. So all these finer points of language, which I think are very important from a conceptual point of view, people in the market don't have time to think about all these things. They're too busy trying to make money. So therefore, they're not that particular about how they use the language. Okay, but when we are teaching students about finance, we have to be very particular because the conceptual structure in your head has to be clear. Okay, that will help you to operate in a more effective manner. Okay, so this is TAM versus AM, and you understand the connection to asset allocation. So obviously, if you're doing asset allocation in AM, if you're doing asset allocation in AM, generally you will be free to move into other areas also, like here. You go back to futures. You will have in asset allocation in AM, decide to go into equity indices. You can decide to go into bonds. You can go into commodities. In that, we can go into energy, softs, metals, grains. Then you can go into currencies like British pound, Canadian dollars, all kinds of stuff. Okay, so your scope of the asset allocation discussion in an AM context is much broader because you're allowed to go into any asset class. Right? So this is an important thing to understand. Three different on 3 important points they are different. Okay, and then the asset allocation discussion. So most of today has been spent on this. Okay, we will continue with this and see. Okay, yeah, there's another set of terms that we need to talk about. Okay, we just continue with the book. So yeah, that's why he's talking about an all bond policy, which means he's talking. This is an asset allocation decision that he's saying put all the money into bonds. Okay, should we do that? That's what he's asking. Now, on page 20 that I have mentioned here, defensive versus enterprising. He's talking about two types of investors, defensive versus enterprising. Okay. Now he's also used the word passive. Okay, and he's called active. So you can see the discussion here. Okay. Now this is also, these terms are actually used in industry in a very specific way. Again, these are terms of art. So you have passive versus active investing. Okay, so anybody wants to give their view on what is the difference between passive versus active investing? Not so much defensive versus enterprising, but let's take, this is explained in his book. Okay, similar, it's a less precise. But in the industry, when we talk about passive versus active investing, there is a very specific kind of distinction between the two. Anybody wants to hazard a guess what it is? How do we distinguish between passive versus active in the industry? No one?
Sir, a passive investor rarely buys and sells and typically buys index funds. And we can say an active investor adjusts stocks like he picks very few stocks.
Okay, good. So yeah, Ayush's answer is correct, especially the second part of the first answer, which is typically invest in index funds. So what he does is here, if you see this one, okay. So in the passive investor wants to make his life easy. You can read the part on page 20 how he's defined it. Okay, but this is basically the difference between passive and active. That in passive investing, we don't want to spend too much time, and we believe that we can't actually beat the broader market. So passive, this is also important to connect to this idea of semi-strong form market efficiency. Because remember, all the concepts we study, we must also be aware of the interconnections. When we are studying something like passive investing, and Ayush has explained it correctly, that he's talking about typically investing in index funds. Why do they invest in index funds? Because implicit in the passive investor's viewpoint is that I don't have the skills, or I don't want to go through the trouble of trying to beat the market. That is to beat the market indices. Here, you see the indices: Dow Jones, S&P 500, Nasdaq, technical. These are small cap index, Russell 2000. This is a Japanese index. This is a European index. This is a German index. So if you have an international equity portfolio, you can invest a little bit in Japan, a little bit in Europe. And if you want to concentrate on Germany, the biggest economy in Europe, you can put a little bit here. And then you have other French indices or CAC 40 and things like that. You can put it in the FTSE in the UK, etc. So all these kinds of things you can do. But the point is that you're basically saying that I don't have the time to do, and I don't think I can beat the market. So this guy, the passive investor, is actually, he believes in semi-strong form market efficiency. Please understand that. It's important for you to connect to this, that the passive investor believes in semi-strong form market efficiency. The active investor does not. So the active investor, again, as I correctly pointed out, is a stock picker. Okay, we call these people stock pickers. So they go and select individual stocks. They're not concerned with trying to match this particular S&P 500 or what are the Nasdaq 100 stocks. They say that we are going to select the stocks on our own. Okay, so that's what these people believe. So, okay, 1 minute. I'll just wrap it up in 1 minute. Okay, so the difference between, because then we can study, we have completed one more concept today. That remember, semi-strong form market efficiency, fundamental analysis of no use. So passive investors effectively believe in this. Active investors don't believe in this. Okay, and they want to, they feel that they can do better than these indices. So they do what is called stock picking. They do stock picking. So they will actually select individual stocks. So they'll go into, okay, I don't care what the Nasdaq indices are. Okay, let me go into this and let me select some particular tech stock. Okay, this will also get connected to a point later on, which we're going to discuss on. Sorry, we're going to go into maps. Okay, like, so the guy was decided, okay, I'm going to put money into Microsoft. I'm going to put money into Amazon and Tesla, but I'm not putting money into Apple because I don't think it's going to do well. I won't put money in Nvidia. Okay, so this is got to be the philosophy of an active investor. So there is active stock picking and making bets on individual stocks and believing that you can beat the index. Okay, that's basically the idea. Okay, so we covered a few things today. Important concepts. Make sure you understand them. Revise. TAM versus AM. What is asset allocation? Then passive versus active investing, and connected to defensive. If you read this chapter here, okay, read this the page what he's talking about. Okay, so I've taken 1 minute 40 seconds extra, so your class is dismissed now. Okay, and so the rest of you can go, and those who have questions can stay back. Remember your quiz date. Be ready. I'm not going to give you any more warning. Okay, you'll straight go into the quiz date is given over here. Okay,
So Ritvik, this side, I joined actually 10 minutes late.
No. I saw your message. I've already given the message. You have to contact ma'am for that. Because anyway, I will share the folder with her once the course is over. You contact ma'am about that later on, because I can't do anything about that. My job is to take the attendance and faithfully mark the attendance. Okay? So that's basically all right. You follow up with her on that. Okay. All right. So we are done now. Any other questions, folks? Anybody? Any other questions?
No, sir.
Okay. All right. Okay. So then I'll stop the recording. Okay. And I'm trying to generally put the recording up on YouTube by the same night. So if you prefer to watch there, otherwise it will be there in the stream also. You can download it. Okay. So stop the recording. Stop recording.